the point I would make, about this is that really tax law, it really does exist in a vacuum. Just reading, Section 904A regarding the foreign tax credit limitation, it's absolutely meaningless unless you have a situation to apply it to. And as a result, we really need to have mechanisms to force ourselves to be looking at a rule and saying, well, gee, why is it there? And that mechanism is some sort of a case study with actual facts that you say, gee, this situation, that's my client. I need to learn about that client's business. I need to learn as to how they're organized, where they have people, what are they doing. I need to know all that information. What contracts have they entered into? What do those contracts say? Then those code sections will have a real meaning because you're actually applying them to a real live situation. Now, with that in mind, we will use that some in class discussion, and we will use it very definitely as part of the group project for the quarter. I think you've seen this. This is, again, to give some real life to it. Real multinational companies will have an organization chart which might look like this, except typically it'll be larger. It is not unusual at all for a group, a major multinational, to have anywhere from 200 to 1,000 or more subsidiaries. Have any of you taken a course that involves consolidations? The consolidated tax return rules? Is that something you've taken yet? Well, I see at least one or two heads. When you have a consolidated tax return, conceptually it's really nice and easy. You get you show income, different types of income, salaries, rent, so on, down to net income. And then you have a column for each company, the parent company and all the subsidiaries that are included in what's called the affiliated group, which basically means the domestic companies in the group that are 80% owned. Well, today, you guys use computers, and tax returns are prepared using computers. One of my fondest memories is from the mid-1970s, working on the bankruptcy of a big group of stores, which the remnants of which is today Toys R Us. But try to imagine this kind of thing done with paper and pencil. And then back then, because fortunately we had the Xerox machine, we were able to Xerox the sheets, as opposed to something else. But anyway, there's these are real. They there's a column for each company, and they all come together. So now here, as you look through it, you'll see, okay, there's some companies which are domestic. There's some companies that are foreign. There's, I think, one or two partnerships in there, joint venture companies of various sorts. And that's real life. There is this kind of variety. So this ties in with the the 30 some odd pages of description which you have in your course booklet and which you also have in soft copy on the website for various situations. What's one of the situations so we know what we're looking at? Okay, let's say that one of the domestic subsidiaries of the group has a representative office. In this case, it happens to be in Japan. And a representative office is effectively like a branch in the sense of the company of which it's a part. It's not a separate legal entity. So you have, at the top, you have, of course, the parent company, and then you'll have Win Computer Inc., which is a domestic subsidiary included in the consolidation. And then that company happens to have an office doing something in Japan. So there's some discussion of what they're doing and a particular situation that they're considering. So my original idea was just to, again, list the code and regulation sections which would help you find what those issues are. After thinking about it further and actually talking to one of your group about it, I decided that perhaps a little more guidance would be useful and would limit the amount of time you would spend spinning your wheels trying to figure out what things really relate to. So what I have done is to include at the bottom of each of these a series of questions which will focus you on the issues which you then need to either research or think about or whatever it happens to be. So I don't want you to be spinning your wheels to no effect. I want you to be a little more focused, and I think you'll end up spending your time in a more wiser fashion. And you'll see that I've generally included in brackets after each question things that you should look at. In this case, it happens to be a tax treaty. In other cases, maybe it's a particular regulation to look at. Okay, I have a few slides which I've labeled the big picture, which tries to get to a little bit about the environment that we're working in. Do you think the environment that we're working in really represents reality? Or do you think this is, in a sense, how many people have seen the movie The Matrix? Okay, so what do you think? Do you think this is reality, or do you think that we have and are working within a construct that dictates how we act? It's more this matrix analogy is more real than it's not real. And we'll try to talk a little bit about what that means as we go through. I just noticed somebody looking at the clock. I'm absolutely shocked at that. But since we are close to 7:30, and this is a good stopping point for 10 minutes, let's take a 10-minute break. Yeah, thank you for looking at the clock to remind me. Big picture. Okay, so what's this construct? What's this environment that we are working and living in? Okay, sort of a first point is that the U.S. has a worldwide taxation concept of its citizens and domestic corporations. Fine. And what's missing from this, of course, is foreign corporations. Foreign corporations, yes, can be taxed, but only to the extent they actually conduct a business in the United States, or they have U.S. source income of certain types. Now, a lot of the, maybe not a lot, but a reasonable amount of complication that you see within the tax law, especially subpart F, somewhat the sourcing rules, are based on the fact that some of these foreign corporations that are owned by U.S. persons will in fact have some U.S. income. Now, for our purposes in this course, I would say that's an exception. In the real world, so to speak, of multinationals, usually, not always, but usually, if a multinational headquartered here wants to do business overseas, fine, they'll use a foreign company, but they're not going to use that foreign company to then do business in the United States. So, again, to keep our focus on what's important, we're going to, for the most part, ignore a lot of those special rules and details which are there solely because a foreign corporation owned by a U.S. person could conduct business in the United States. So we'll generally ignore those things because it's normally sort of out of scope. The kinds of companies that you're dealing with normally will not do that. Anyway, U.S. persons obviously can own foreign assets other than shares and foreign corporations. So that's part of the world we're living in. And foreign corporations are generally outside of the U.S. taxing jurisdiction. And again, I'm assuming no U.S. activities or assets for simplicity and reality, for that matter. Now, Congress and the Treasury Department and so on, they have a mentality. And that mentality affects what we have in our laws. And again, that's part of our environment. So there's sort of a overriding function that foreign earnings or any economic gain will never escape taxation if a U.S. person has an interest in it. That runs through a lot of the law which we'll be covering. Make sure that no U.S. person has a gain which never gets taxed. It's okay if it's going to be taxed at some time in the indefinite future, although the accounting rules say, gee, you can still have your benefit. But the tax law, if you've legitimately earned that money overseas in a foreign company, you can leave it there. We know it will ultimately get taxed. It may be at the time a dividend is paid. It may be because Cisco sells the subsidiary and realizes a gain, and then, gee, how is that gain taxed? There's a section on that. It may be because the foreign subsidiary makes a loan to Cisco, allowing Cisco the use of the money. Well, that can cause taxation. Or maybe Cisco borrows from a bank using the assets of the subsidiary or the stock of the subsidiary as security for a loan. That can trigger taxability. But if Cisco never instructs the board of directors of this company to declare a dividend, and this company never does anything which triggers some of those events which can cause taxability at the Cisco level, that 15 of difference is not paid. But it's a potential amount, and the tax law and Congress says as long as the potential is there, we're comfortable. We're going to allow that to be there as long as there's still potential to tax if the money is repatriated or otherwise used in the United States. Okay, classical system. Now, you may think of the classics and think of Greece and Rome, but in this sense, the classical system means that there's two levels of taxation. There's taxation at the level of the subsidiary, and there's taxation on the shareholder. If both of these were U.S., if this was, let's draw a slightly different picture. I think my abilities at drawing are being brought into question. Anyway, if we have an individual that owns a company, classical system says that this one, under today's rates, is taxable at 35%. When it makes a distribution, taxable as a dividend, this individual will be taxed. Now, today, you know that, gee, it's a 15% rate under the special rules. But that's only in the last, I don't know, 4, 5, 6, 7, 8, 10 years since Bush made some changes. Before that, the dividends were taxed at whatever the marginal rate of the individual was, which I think today is also 35%. So if we have 100, we pay 35 here, we have 65 left over. 65 is paid as a distribution. We have dividend of 65. 65 times 35% gives us whatever the amount is, let's say roughly, around 20 something. And that means that the 20 plus the 35, it's going to be around a total tax of about 55. And today, because of that 15% rate, okay, this 55 has come down, but it's still a total which includes taxation at two levels, the corporation and the shareholder. And again, the reason I'm bringing this up, this is part of our environment. We have a classical system. Do all countries have classical systems? No. A reasonable number of countries would say that once you've paid the tax at this level, there's no further tax effectively on the individual. Or they're sort of brought together, and the ultimate tax of the earnings here end up being taxed at the marginal rate of the individual. In other words, so if you have brackets at the individual level, ultimately those corporate earnings are taxed at his rate. That's often referred to as an imputational system. So anyway, the environment we're in is a classical system, which you might say is modified a bit because of this 15% rate. Now, another guiding part of the religion of Congress is that you, as a business person, or as a company, or as a taxpayer, should be making decisions independent of taxation. Do I form a foreign subsidiary, or do I operate through a branch? As we'll see, there are mechanisms to equate the taxation of the two, so that you're making the decision based on good business and legal factors, not including taxation. Does that work perfectly? No. But the mechanisms are there so that at least the system tries to allow you to make your decision without tax as a major factor. So that's behind some of these things. Now, if you've paged through at all the code sections and regulations which are part of the coverage of this course, if you didn't get nauseous, there's something wrong with you. So, did you get nauseous? Are you suggesting there's something wrong with you? Okay, well, the point is that there is a lot of complication. Is that what makes taxation interesting and complicated? No, it's not. Actually, the interesting part of taxation as a business, as a profession, is applying the law to real situations and understanding the situations and so on. And again, we'll get into that more later. But the basic concepts in tax law are actually pretty simple. Whether we're talking about the U.S. system, which has this terribly heavy paperweight, and this is only one of two. I didn't bring the other one because it would be too heavy. We have a thick internal revenue code. Do other countries have a thick internal revenue code? Well, some do, but Australia's terrible. UK isn't so good. But there's a lot of countries where you can sit down and read the whole tax law in an hour. Gee, that's pretty nice. Are things less complicated there? No. Why? Because the complication arises out of the factual situation you're working with. So the weight of the Internal Revenue Code is not actually the issue. The concepts are still there and relatively simple. And for the most part, they make sense. And once you learn a little bit about them and why they make sense, again, you don't have to memorize them, because once you understand a little bit about the environment and how things work, well, it makes sense that it's that way. Now, again, though, why is it so thick? Well, one thing is that there are some industries that have peculiar natures. The insurance industry, or the banking industry, financial services, mining, oil and gas. Because for many of those industries the dollars are so big, and without detailed rules, Congress's mind is, gee, they get away with murder, which they do anyway, but as a result, you get just a tremendous amount of verbiage trying to deal with every possible situation that could occur. And of course, the Treasury in proposing, trying to identify issues, and Congress and reviewing them and passing them is always, behind times, because companies and individuals are doing things that they realize they can do, because we have a very much rule-based system. A country that has a very much shorter law that you can read in one day, and Russia does not have that today, I'm sorry to say. A country that has a very simple, easy-to-read law, in a sense, operates as a principles-based system, because the details are not there telling you what to do every morning. That you have to wake up at 8 o'clock or 6 o'clock or whatever it is. Here we have a very much rule-based system. We say, gee, the answer might not make sense, but it says we can do it. So therefore, if it's to our benefit and to the detriment of the government, we go ahead and do it. So Congress is behind, but the point is, as they identify these things, we get all of this verbiage, all of these terrible regulations which are impossible to read, and that's why a lot of them are there. Now, that doesn't take away from the basic principles, which you hopefully will walk away from this course with. Basic understanding of why things are there, and enough understanding to be able to, again, start on recognizing issues and dealing with them. So, rules-based belief that we need all these special rules for certain industries. Okay, taxpayers getting away with murder, tax shelters or what have you, and you end up with 20 pages of regulations telling why you can't do a certain thing. For example, some tax shelters were developed where two parties in different countries can each claim the same tax as a tax credit in their country. Well, that may give the parties a wonderful answer, but it's also given us, umpteen pages of rules which now tell us why the U.S. person can't do it. The foreign person can still do it, but in his country. But we have, maybe 20 pages of fine print telling us about this. So, again, a lot of it comes from that. The ordinary versus capital distinction. Throughout the history of this country, there's been the designation of certain income as being ordinary in nature, everyday type income, and certain income which is capital in nature. Maybe in some course you heard about the tree and the fruit analogy, that if you sell the fruit off the tree, that's ordinary income, but if you sell the tree or you chop it down or you do something that affects the tree as a whole, that's capital in nature. Now, within the U.S. system, that situation, it's very significant as to whether it's one or the other, because throughout most of the history of the U.S. tax system, there's been very significant differences between the tax rates applicable to ordinary income and the tax rates applicable to capital gain. Well, if you have a person who says, gee, I pay only half as much tax, or maybe even less, if I have a capital gain, well, I'm going to do absolutely everything I can to make sure I turn what would otherwise be ordinary income into capital gain. So a lot of the complication in the code and in the international sections comes from this aspect. Now, as we are going through, and this, I see whether the Next slide gets to this point. Yeah, as we're going through, unless you have a specific personal interest, for example, in the banking industry or insurance or oil and gas or whatever, I'm happy for you to ignore all of those special things that bring in all this complication. If you have an interest, fine, please be my guest. But for purposes of our course, we're trying to look at the, what the rules are there to achieve, how they work, how you would apply them, and we're not looking at trying to look for special rules on this industry or that. So now it occurred to me to put down these 4 bullet points. These are just my thoughts. You may have, you need to develop your own style if you have not done so already as to how to read something, how to read a code section or a regulation. But anyway, my thoughts were this, to not just start reading the first thing and read to the end, but first, how's it organized? Look at the overall, the whole section. How is it structured? Are there parts of it, very often major parts of it, that relate to a specific industry or some situation which obviously is, let's say, tax avoidance motivated or something like that? For purposes of our looking at things, those kinds of things you can just ignore. You may know that they're there because you saw the heading. But don't waste your time reading it unless you have a specific interest. You'll often find, once you've pulled those things out, that the guts or the real gist of what the section or the regulation is about is in just a relatively few sentences. And attempting to find those and understand, okay, why it's there, that should be your focus. This last one, I've certainly learned to my detriment some number of times over the course of my career. Always read to the end of the section. Because very often that important part which affects you, is buried somewhere in the back. So, you need to look through and to the end, make sure there's nothing that relates to you, to your, real client situation. But again, develop your own style. These are just my thoughts in terms of how I try to read something in order to get the most out of it. Okay, now let's get back to this analogy with the matrix. If you get onto Google Earth and you look at the world, do you see boundaries? You probably don't. And if you were to talk to somebody in a major company, or even a small company, who says, and you said to him, well, gee, how do you think about your markets? He's not going to talk about markets normally in terms of specifically countries. Well, gee, we're really trying to move into more Asian centers. Or we're trying to increase our presence in Europe. Or, God forbid, we're looking at Africa. Want to go there? Maybe later. Okay, so, well, one of the situations involves a Nigerian licensee. So this is an opportunity for you. Okay, but anyway, having said that, and again getting back to our matrix analogy, The point is that we do have sovereign states around the world. And they are limited in what they do by jurisdiction. Now, I'll talk more about jurisdiction in the next course in the spring. But jurisdiction, what, as a practical matter, a country can grab, is very, very important from the standpoint of how this matrix construct works. Juridical persons. Have you ever seen a corporation? Does it really exist in the flesh? Can you put it in jail? Can you kill it? I didn't say this, but I spent almost 25 years of my working life with Arthur Andersen. That was killing. The legal entity happens to still exist, but effectively, that was the killing of an organization. Well, yeah, organizations can be killed. You may not be able to put them in jail, but again, let's get back, instead of dwelling too much on morbid topics, let's talk a little bit about what difference is there between what you, hopefully being a human being, and a corporation can do. Can you both contract? Can you both borrow money? Can you both conduct business? Okay, so a juridical person does not in reality exist, but worldwide, every country and the tax authorities of every country take them seriously. How much does it cost to form a company? You go down, go down to your local lawyer and ask him to form a company for you. Is it expensive? Well, maybe you don't know, but let's just say it's not so much. Not so much. Gee, I want to form a company in the Cayman Islands. It's probably even cheaper. So we, as individuals, and a multinational as a company, which is, so to speak, has a wide ownership, and therefore nobody controls the management aside from the board of directors, and maybe most of the board of directors are insiders anyway, or don't understand. If they're independent directors, probably don't understand enough about what's going on to necessarily influence things a lot. But again, that's another social issue. That management of that corporation, it can choose whatever it wants to do. If it wants to open up a branch somewhere, it can do so. If it says, gee, I'd rather it be in a juridical person, it can spend $1,000 or whatever the cost is for that location and form a company. It's easy. They can do whatever they want. Now, it's so easy to do whatever they want. Again, that sort of question of, do tax authorities respect what they do? Have any of you in any of your courses heard the reference to something like a straw corporation? Or any situation where, in a sense, from a tax standpoint, the corporate veil has been pierced and we ignore the existence of the corporation? Have you ever heard of this kind of thing happening? Yeah, it can happen. But what sort of situations is it that this happens? Let's say I form a company, and then that company, through that company, I enter into some contracts. Let's say with another company I own. Okay, I have two companies, let's say. I own 100% of both, let's say. And I enter into a contract between the two for something. I really don't care what it is. Maybe could be renting property from one to the other. Could be to buy goods. Could be anything. Now, if I do everything wrong, now what do I mean by wrong? Well, maybe I set up the companies, but I never go through the corporate niceties. I never have any board of directors meetings and document them. Maybe I pay my annual registration fee, but I, in a sense, am not respecting the box that I have created. And then maybe in addition, this contract between the two, maybe although it's down on paper, I really ignore it. I don't have the two companies follow the terms of the contract. Now, in a situation like that, now I'm mixing two things. I'm mixing, and I apologize for doing so, but understand I'm mixing two things. One is respect of the illegal entity, and then whether the contract is a valid contract. There's actually two issues here. Let's just focus first on the company, the respect for the company. If I don't go through any of the corporate niceties, if I transact things in the name of the company, but acting, in a sense, for my own interest, if I do all these things wrong, then maybe a court in the United States or in other countries would say, well, gee, that isn't a real corporation. We should ignore it because the person who owns it is acting in his own interest and is not respecting what he has created. But if I do the things which I should do as a proper shareholder and member of the board of director, and if I dot my I's and cross my T's, even though I've set this corporation up solely for some special purpose, which has no purpose other than, in a sense, to enter into some sort of a tax-motivated transaction, countries around the world respect the existence of that corporation. That's the environment we're in. That's the matrix-like construct that we're in. We may look at this and say, God, this is really a lot of nonsense. It's all me behind whatever these companies do. They're really just my alter ego as a practical matter. But if I dot my I's and I cross my T's in terms of the corporation's existence, and if I enter into contracts, getting to that other part, the legitimacy of the contract, if I enter into a contract which I respect the terms of, the parties respect the terms of, they happen to be related, then generally what we have created is respected legally. That's our environment.